Now, you might think that's not true. The interest rates have been high for the past year, and yet the S&P 500 has had double-digit returns. Why?
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride.
Welcome to Critical Thinking Required. This is your host, Nathaniel Leach. And as always, if you find this episode helpful, please like, share, and subscribe. So today, we're going to be talking about interest rates. As you may have already heard, the Federal Reserve announced that it plans to hold interest rates steady and forecasted just one cut in 2024 instead of the original 3 to 6 that the market was thinking of earlier this year amidst high inflation. What does that mean for your investments? So when interest rates increase, borrowing money becomes more expensive. This can slow down economic growth because both consumers and businesses may cut back on spending. For your investments, this often means that stocks could take a hit. Why? Because when the interest is that high, bonds become a lot more attractive than stocks, since they're considered less risky. So on the flip side, when interest rates decrease, borrowing becomes cheaper, which can stimulate economic growth. This tends to be good for the stock market as businesses can borrow at lower costs to expand operations, consumers are more likely to spend, and stocks look more appealing versus bonds. Now you might think that's not true. The interest rates have been high for the past year, and yet the S&P 500 has had double-digit returns. Why? Because of the debut of ChatGPT and other tech companies raving about artificial intelligence, or AI, the market has been in an over-optimistic mood about AI development. And markets, as we keep saying, consist of people. In this case, people's over-optimistic feelings trump economic principles. What has the past 2 years of normal market increases taught us? Sometimes it is impossible to predict what the market will do. All key factors, elements in overall economy says that the market should have fallen, and yet it remains strong. Now, it's not to say that it will never fall. That would be a deadly mistake. However, it's important to remember that in the short term, factors such as interest rates will impact your investment for sure, but it could also do 180 due to other short-term events. If you're a true long-term investor, the macro environment should not be your top concern. What does matter to your investment in the long term is a true understanding of your investment's underlying business and leadership. That's all for today, and I hope you found it helpful, and I'll see you next time.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.